Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about Docebo Inc. They trade on the NASDAQ under the ticker symbol DCBO, and they are a enterprise management learning software. And this is a really cool company. Today what we're going to talk about is a company valuation and my opinion on the company from a summary perspective. We're going to look at the charts and talk about where they've been and where I see them going. And then lastly, I'm going to provide kind of a summary of the catalyst or potential dangers that I see for the stock. All of this is just my opinion because I am by no means a financial advisor. I'm just some guy on YouTube, but I hope you find this helpful. And if you do, please consider leaving a like and subscribing. Awesome. So let's dive in and talk about what Docebo does and who they are. This is a really cool company. They are based out of Canada and they are a huge market leader in the space. So while I have this up on the screen, you can talk about some of the items here. The main point I want to focus on is right here we have employee onboarding and employee development and retention. The main thing that I want to focus on when we talk about that is when a company has a new hire, and in the software space in particular, there are a significant amount of new employees coming on board at this point in time. And as such, we're seeing a lot of onboarding processes that do not work. The sooner that you can get an employee from being another body to being an income producing individual and have them be profitable for the company, the better. And Docebo software is very, very good at doing that. And they've been able to continuously showcase that over and over again. Another thing that you're able to use this for is for onboarding your clients as a customer, and you are able to utilize it for sales enablement. My future state, or one of my expectations I think the company could do, is I actually think that they could automate a lot of e-learning from what we see in the classroom. One of the reasons why I am very bullish on Docebo is because I have been an end user of their software, and I think that it is incredible at helping to onboard for difficult or complex concepts. That being said, the company currently has a market capitalization of $2.8 billion, and I think that that is coming in at a high price due to the fact that they have a very expensive valuation with a price to sales of about 35, and they are currently not profitable. But like many companies in the software space, that is pretty normal. You can see that the vast bulk of their shares are held by institutions, with 40% of the total share volume being held by the company, and they currently have right at 32.7 million shares outstanding. So all of that being said, the company is on the higher side of their overall 52-week range, hitting that new high as of last week, and you can see that they've kind of tapered back down a little bit. So the company had a very strong earnings report showcasing very strong revenue growth. They've continued to grow during that point in time. You can see they're up more than 100% from the April-May lows, and they're about 50% higher than where they were at the beginning of the year. So this is kind of setting the stage for the company in terms of where they are at. So what I want to do next is focus on some of the fundamentals associated with the company. So you can see that they're a relatively new company, and since they've come on board, they had a 502% increase in value in 2020, and you can see here in 2021 that they've had a increase from the year low of $37.21 all the way up to as high as $92.75. So there's a lot to like about this company. However, you can see that they are coming premiumly priced, and I expect that that's going to continue as their growth continues. So you can see that the company has had this decline over the past few days because some of the inside holders have been selling off through a share offering from those securities holders, so that share offering does not benefit the company from a revenue perspective. So let's talk about kind of where the company is today. You can see from an overall cash and debt position that the companies continue to perform very well, and basically the debt has stayed flat. But through their share offering that they went through last year, they were actually able to come online in a fantastic way. Very, very strong cash position that has continued to stay the course and kind of been even. What I'm looking at going forward is this income statement position right here. And you can see that the company has continued to grow incredibly well, and you're seeing this at a rapid pace. The thing that's concerning is that to get these sales, they've had to double their selling expenses. So this could be hiring additional sales reps, which they are hiring a lot of different positions. They've expanded internationally, and the company overall has continued to see a massive increase in expenses, nearly doubling in the past year. What this has caused is you can see that the net income continues to be pretty monumental losses on a quarter-by-quarter basis, and we definitely want to see this be transformed into some positive cash flow at the end of probably 2022, 2023 is what we'll be looking for. So that's not something that's on their near expectation, but is definitely something we want to watch going forward. They definitely have the cash on hand to be able to handle that. So why do I think that they're going to continue to grow, and what are some of the benefits associated with the company? To look at that, we're actually going to go to their investor presentation. So this is a presentation that they released last month in August 2021. What I want to highlight is a few of the things here on the screen. You can see that they have an annual recurring revenue, that's what that ARR stands for, of $93 million as of the June 30th numbers. That means this is not necessarily new money that they have to go out and get. They do have to keep those contracts renewed when they come to renewals. However, generally speaking, it's easier to keep money than to go out and get new money. Also, it's easier to cross-sell and upsell into these client bases, which, as you can see, the customer base is pretty substantial, and the employees are continuing to grow. So they're based all over the world, with the U.S. presence being here in Athens, Georgia. So what we're going to be looking at is how can they grow. And so this is a few different items in the company in terms of what they do, who they work with, including Amazon Web Services, which is one of the key reasons why I really like the country, because Amazon has a vested interest in the company. But what I'm going to be looking for is how can you expand, how can they grow? So you can see already that we're seeing the market for a Docebo-esque company has expanded dramatically. The idea of e-learning, of e-onboarding is growing incredibly rapidly, and I don't expect that trend to change, although you may see it slow down since we've had such a rapid increase over the course of the past 18 months. The expectation is that this is going to continue to grow, and you can see the company itself has continued to grow with a 65% recurring revenue CAGR, which is compound annual growth rate. They will continue to dominate the space if any of this is capable of being repeated. So you can see right now that that 74% is somewhat leveraging this at a higher rate. But if they can maintain 50%, the only other companies you're seeing do this in the software space is really Salesforce, which one of my conspiracy theories with the Docebo is I think that they would be a strong acquisition target for Mark Benioff, who's the CEO of Salesforce. So that's something that I could consider looking at going forward. But so far, they've continued to grow incredibly rapidly. You can see kind of some of the deal size, and the average contract value has continued to grow as they've been able to go out and get larger clients, as well as the fact that you can see that annual recurring revenue number continues to grow as well. All of that means that they've been able to leverage very strong capital growth using that revenue. Again, we want this to be profitable though, which is what we'd really like to see. All of that looks here on the screen to be very, very strong approach. We just looked at the fundamentals, but we're looking at this in a different way. What we'd like to see is, will the 2021 numbers end up being positive from a free cash flow margin? Because with the gross profit margins that you see there, we expect to see profitability in the near future. Again, I think it'll be around 2023 is really when we're seeing that. The last thing that I'll highlight is just some of the KPIs that they look at. Again, that free cash flow was very strong, positive 2020. We'd like to see that continue into the latter half of 2021. Q3 and Q4 in the software space tend to be pretty strong, with Q4 being when the bulk of the deals arrive. So with all of this information, what do we expect the stock price to do going forward? So I have up here the year-to-date chart, but what may be more applicable would be like the 3-month chart. You can see that the stocks continued to go up. It bounced off 90 after briefly breaking above it, and now we're seeing this pullback with the current price or a current stock price of $84 a share. The concern here, or really what I'll be watching for, is I'd like to get involved in this stock under $80 a share. The reason for that is because I do think that this is a long-term growth company and there's a lot of value associated with it. However, they just had a monster run. They are extending themselves quite a bit, and I think that there's going to be some pullback in the software space, and they're already experiencing that. Under $80 would be my ideal position, because as you can see, you don't maintain this growth trajectory that we've seen right here, going from lows in the 40 to more than doubling in under 12 months. For that reason, I'd like to see it under 80 before I start building a position. Probably not going to go all in at one time, but start building it because I love the e-learning space. And again, I am an end user. That's how I got involved in Salesforce investing, which if you looked at it today, it was up 7%. Very, very strong company. And I think Docebo could be a strong acquisition target for them, or in its own right, just another very strong software e-learning type of company that has incredible commercial applications. For that reason, I will begin or look to buy in Docebo when they crest under $30 or $80, sorry, $80 a share. So that's what I'll be looking at. If we don't hit it, I may change the strategy, but that's what I'm looking for currently. So if you find this type of content helpful, please consider leaving a like and subscribe. Today was a fun one talking about Docebo. We talk about a lot of companies in the Discord, which is in the description down below. So thanks for watching if you made it this far, and we will look forward to talking to you later. Thanks. Bye.